They want your silver. On the surface, it sounds like clickbait, another breathless claim thrown around on late-night finance channels. But behind the drama is a dry, technical acronym that actually does sit over the heart of the global financial system. G SIB, short for Global Systemically Important Bank. These are the institutions that regulators have decided are simply too big to fail. And whether you realize it or not, they stand between you and the metal you think you own. The real story isn't about a gang of bankers breaking into vaults and stealing coins. It's about how the structure of the modern banking system quietly transforms your silver into a tool for their balance sheet management leverage and profit. To understand how that happens, you have to begin with what a GSIB really is. Every year, the Financial Stability Board, working with the Basel Committee, publishes a list of the world's systemically important banks. Think of names like JP Morgan Chase, HSBC, BNP Paribas, Deutsche Bank, Citigroup, and others. They're huge, global, deeply interconnected, and their failure could destabilize the entire system. Because of that, they are subject to extra capital requirements and incredibly complex rules governing what they hold, how they fund themselves, and how they manage risk. Precious metals, especially gold and silver, live inside that rulebook, not outside it. You've probably been told a simple story about silver. It's a hard asset, a hedge against inflation and currency debasement, something real as opposed to the digital entries in a banking database. That picture is emotionally satisfying, but incomplete. In the world of G SIBs, silver is not primarily treated as a coin in a safe. It is a position, a derivative, a collateral pool, a liquidity line item. It appears in their internal systems as exposures, risk weights, capital charges, and funding requirements. Once your silver is inside that system, especially as paper silver in an account statement, it is no longer just a bar. It becomes part of how a global bank meets the rules that govern its survival. These banks sit at the center of the precious metals markets. In London, the LBMA, London Bullion Market Association, is where most wholesale gold and silver trading occurs, and its clearing members are mainly large global banks, many of them GSIBs. They run the unallocated accounts through which most bullion trades flow. In New York, COMEX futures are cleared through a handful of major financial institutions. When you buy silver through a broker, an ETF, a bank certificate, or an unallocated or pooled account, you are almost always connecting, directly or indirectly, to one of these big institutions. That's the plumbing. It's invisible to retail investors, but absolutely central to what happens next. Here's the uncomfortable fact. Most silver ownership in the world is not ownership of specific bars. It is a claim on a financial institution that, in turn, is part of a chain of other claims, hedges, swaps, and offsets. If you hold an unallocated silver account at a bank, that silver is not sitting there with your name on a bar. It is a liability of the bank, an IOU. The bank may maintain a pool of physical silver, yes, but it also nets exposures, uses derivatives, and relies on the assumption that most clients will never ask for large-scale delivery at once. That assumption is not a conspiracy, it's the core business model of modern banking. Where GSIB rules enter the scene is in how expensive or cheap it is for these banks to offer that model. Basel III and related regulations imposed liquidity coverage ratios, leverage ratios, and something called the net stable funding ratio, NSFR. These are designed to force big banks to fund long-term or volatile assets with more stable sources of funding. Commodities and precious metals, depending on how they are structured, can be balance sheet heavy and require a lot of stable funding under these rules. In plain language, if a GSIB holds a lot of unallocated precious metals liabilities to customers and backs them with short-term funding or complex derivatives, regulators now make that more expensive. Now introduce suspense. If regulation makes something more expensive for a GSIB, they don't just accept lower profits. They engineer the product, the market structure, or the customer relationship, until it again works in their favor. Silver, inside this machinery, is nudged and shaped accordingly. The "they want your silver" angle isn't that banks crave stacks of coins. It's that your desire to own silver, especially in convenient paper-like forms, creates a flow of capital and exposure they can transform into tradable risk, fee income, and balance sheet optimization. Your silver is raw material for their machine. But notice the gap between your mental picture and their reality. You imagine a bar with your name on it, a tangible backstop against monetary chaos. They see a position that can be netted, rehypothecated, lent against, swapped, and hedged. You think in ounces. They think in notional exposure, value at risk, and return on equity. And in the middle of that gap lies the core, secret Ink. A large part of the silver market is effectively a credit system layered on top of a finite pile of metal, run through institutions that regulators have designated as critical to global stability. and yet whose internal workings are too complex for almost anyone outside the industry to fully track. This is not to say that there are smoky rooms where GSIB CEOs plot to strip you of your silver. It is more subtle and, in some ways, more unsettling. The incentives built into regulation and profit-maximizing behavior push these banks to treat your silver as a flexible financial instrument, not as sacrosanct stored wealth. When you sign up for exposure to silver through a product they design, revenue streams open up on their side. Spreads on trades, lending fees on metal loaned out, derivatives, profits from hedging your positions, and potential gains from managing the timing and scale of deliveries versus their own inventory. The hook, then, is simple but real. The more people choose paper forms of silver while believing they hold something equivalent to physical, the more leverage the G SIB-centered system has over the overall market. Your silver, in aggregate, becomes part of a vast web of promises managed by a few regulated giants with complex incentives and substantial power. The story only becomes truly tense when you add one more ingredient. What happens if, one day, too many of those promises are called in at once? That question is not hypothetical. We've seen, in other markets, what occurs when confidence in a leveraged system falters. But before we get there, we need to look more closely at how GSIB regulations actually intersect with silver, how balance sheets are structured, how derivatives magnify the size of the paper market, and where the real bottleneck lies between your statement and a real bar in a real vault. That's where the numbers start to get uncomfortable, and the notion that they want your silver takes on a far more concrete meaning. To see how deeply your silver is entangled with G SIB mechanics, you have to leave the reassuring simplicity of coins and bars and enter the world of bank balance sheets and derivatives. A modern G SIB is not a big vault with piles of metal. It is an enormous, constantly shifting ledger of assets, liabilities, off-balance sheet exposures, and regulatory constraints. Silver shows up in that ledger in multiple guises, many of them invisible to you. The suspense lies in how small the physical base is compared to the financial claims built on top of it. Start with some scale. Global silver mine production in recent years has been on the order of roughly 800-900 million ounces per year. Identifiable above-ground bullion stocks are in the low billions of ounces when you aggregate COMEX inventories, LBMA vaulted holdings, government reserves, and known ETF holdings. It's a meaningful amount, but finite. By contrast, the notional value of precious metals derivatives reported by the Bank for International Settlements, BIS, runs into the hundreds of billions of dollars. Other precious metals in those reports are largely silver. While not all of that notional directly maps to outright silver exposure, it indicates a layered structure. Instruments on top of metal, and instruments on top of those instruments. In London, most wholesale silver is traded on an unallocated basis. When a refinery, miner, industrial user, ETF, or large investor transacts, they typically deal in book entries within the LBMA clearing system. A big GSIB bullion bank, say HSBC or JP Morgan, credits or debits an account, obligations. Between banks are netted. Only a small fraction of trades result in actual bar movements. From a GSIB's point of view, customer unallocated balances are liabilities. The metal they hold, contracts they own, and hedges they've set up are assets. The spread between those, adjusted for hedging and risk, is where they make money. Basel III's net stable funding ratio, NSFR, enters here in a technical but crucial way. NSFR requires banks to fund longer-term or less liquid assets with a certain proportion of stable funding, equity and longer-term liabilities. Certain types of commodities, including precious metals, are treated as requiring significant stable funding if they are not structured in particular ways. Unallocated precious metals liabilities to customers, for example, can be balance sheet heavy because the bank has promised to deliver metal on demand, but may be funding that promise with short-term borrowing or derivatives. Regulators fear that, in stress, such mismatches could blow up. To fix that from a regulatory standpoint, GSIBs have three broad options: shrink the activity, reprice it to cover the higher capital, and funding cost, or restructure the products so that they fit better within the rules. All three have been happening, mostly out of public view. Some European bullion banks reduced their metals activities as NSFR went live. Others tweaked client agreements, made terms less favorable for physical delivery, or pushed clients toward products that can be more easily hedged with exchange-traded futures. Still others repriced unallocated accounts, increasing fees or reducing interest paid on metal deposits. From a distance, these are dry adjustments. Up close, they change the character of your ownership. Every time a bank nudges clients from allocated to unallocated, or from direct physical to an ETF share, or from spot metal to a futures-based product, the overall system becomes more layered. An allocated bar in a segregated vault slot is simple. You own it. The bank holds it for you. Unallocated silver is more complex. You own a promise from the bank. and the bank uses that promise as part of a pool that it can lend, hedge, or otherwise deploy. ETF shares add another layer. You own a claim on a fund, which owns metal through custodians, often G SIBs, who may themselves use sub-custodians. Each layer adds potential frictions between you and the metal. Now add derivatives. G SIBs are the primary dealers and market makers in silver futures and over-the-counter forwards and swaps. A silver futures contract on COMEX is a standardized agreement to deliver or take delivery of a certain number of ounces at a future date. Most of these contracts are never settled in metal. Traders offset their positions before expiry, rolling them forward or closing them out. G SIBs sit in the middle, offering liquidity and hedging services to miners, refiners, industrial users, hedge funds, and ETFs. For every long, there is a short. Gross notional can be enormous, even if net exposure is much smaller. This is where the sense of a secret begins to form. To a retail holder, the existence of a huge paper silver market can feel like a trick. How can there be this many claims relative to the physical? In truth, derivatives are not inherently fraudulent. They are tools for transferring and managing risk. But they can create a mismatch between perceptions and reality. You might believe that rising investment demand should push silver prices inexorably higher. Yet, if increasing demand is mostly channeled into derivatives and unallocated accounts that G SIBs can hedge and offset, the immediate upward pressure on physical spot prices can be muted by the structure of the market. Consider a simplified example. Suppose a wave of investors buys a silver ETF. The ETF, following its mandate, sources metal and stores it with a custodian, often a G SIB. To manage the inflow, the custodian may draw from existing inventories, borrow metal on the interbank market, or use futures to hedge timing differences between when it gets cash and when it secures metal. On the other side, industrial users might be selling forward production, locking in prices. Speculators may be shorting futures against long physical holdings. The net effect is a swirling complex of positions in which the price emerges from the interplay of leveraged players, hedgers, and G SIB market makers, not from a simple more buyers than sellers story. The suspenseful part is not that they have rigged the game so you cannot win. It's that the system can absorb astonishing volumes of paper demand without necessarily straining physical inventories, until, suddenly, it can't. As long as confidence remains that paper claims are as good as metal, that unallocated balances can always be converted to physical, that ETF shares are fully backed and redeemable. At the institutional level, the leverage in the system remains latent. But the tighter regulatory environment for G SIBs via NSFR and related rules has already begun to shift how much balance, sheet space, and stable funding they want to devote to maintaining that illusion of perfect convertibility. In that sense, they want your silver can be read another way. They want your willingness to accept their promises instead of insisting on direct possession. That willingness is what allows them to multiply the effective supply of marketable silver claims without possessing equivalent bars for each one. As long as you're satisfied with A shoe Z on a screen that says X ounces, they can keep that machine running. The question, which we'll push closer to in the next parts, is what happens when enough people decide that a screen entry is not enough, and how the G SIB framework shapes the outcome when paper and physical collide. At this point, the BIMG SIB secret looks less like a single smoking gun and more like a pattern. Giant banks at the center of the silver market, heavily regulated, using your desire for silver exposure as a raw input for balance sheet engineering. But there's another layer that has added fuel to the suspicion that something darker is happening. Documented cases of market manipulation, and the structural incentives for G SIBs to prefer a certain price environment for silver. This is where the narrative tightens, because we move from theory and regulation to courtroom evidence and profit motives. Between 2019 and 2020, U.S. authorities brought major cases against traders at JP Morgan Chase and other banks for spoofing in precious metals futures markets. Spoofing involves placing large orders with the intent to cancel them, to create a false impression of supply or demand and nudge prices in a desired direction. JP Morgan ultimately agreed to pay around $920 million to settle charges related to years of misconduct in metals and treasury markets. Traders at other institutions faced fines and bans. These were not fringe players. They operated on the metals desks of one of the world's largest G SIBs, a dominant participant in the gold and silver markets. What does spoofing have to do with they want your silver? It shows that at least some parts of the system have not merely passively intermediated demand. They have actively manipulated short-term pricing to their advantage. While regulators stress that such behavior is illegal and punished when discovered, the cases reinforce a broader concern, that the complexity and opacity of derivatives markets give large players scope to shape prices in ways retail participants don't fully grasp. If a GSIB can, at the margin, tweak price behavior to improve the performance of its book, and if oversight often lags reality, suspicion is not unreasonable. However, it is a leap to say that GSIBs are running a coordinated long-term conspiracy to suppress silver. A more realistic and, in some ways, more chilling picture emerges if you look at incentives. Silver is both a monetary metal and an industrial input. Its price is volatile, its market smaller and less liquid than gold's. For a GSIB that uses silver positions as part of a broader risk book, hedging mining clients, serving ETF sponsors, offering structured products, providing loans collateralized by metal, extreme price spikes or collapses are dangerous. They stress margin systems, create counterparty risk, and can lead to funding squeezes. In that environment, what does a GSIB want? It wants a market it can model, hedge, and fund. Sudden upward breakouts in silver can be costly if the bank is structurally short via client exposures, or if its hedging models assume a calmer regime. Very low prices can hurt mining clients, raising default risk on loans and reducing deal flow. The sweet spot is a range-bound liquid market with enough volatility for traders to earn spreads, but not so much that it threatens the bank's capital or funding. That doesn't require a grand conspiracy. It's the natural outcome of risk management priorities embedded in these institutions. Now, layer on GSIB regulation. Under Basel rules, banks must hold capital against risk-weighted assets. Different exposures carry different risk weights. Lending to a government might carry a low weight, lending to a volatile commodity producer, or holding unhedged commodity inventories carries a higher one. Some GSIBs, therefore, will prefer to keep net commodity exposure low, using derivatives to flatten their risk. The irony is that in trying to neutralize their own price risk, they end up being the primary dealers in the instruments that determine the price for everyone else. They stand between hedgers and speculators on both sides, shaping the order flow. From your vantage point as an investor, this can feel like being in a casino where the house not only sets the rules, but can see all the cards. Now, that's an exaggeration, but not entirely unfair. A GSIB metals desk has visibility into client flows that few others match, which hedge funds are building positions, which industrial users are locking in prices, which ETFs are adding or redeeming shares, which miners are hedging production. They can't legally front-run client orders, but knowledge of flows influences how they manage their own risk. Your silver trade is a data point in a much larger picture they see in you don a T. Here is where the secret bites. The system is structurally designed so that the more you trust paper, the more power accrues to G SIBs to intermediate, shape, and at the margin, influence the market. They don't need to literally confiscate your silver. They need you to keep it in forms they control. Unallocated accounts. ETFs with GSIB custodians, derivative-based products, so they can treat it as part of their extendable, hedgeable, and fundable inventory. You get price exposure, they get spread income, optionality, and a deeper integration of your wealth into their machine. The suspense comes from imagining what happens if something breaks that trust. Suppose a major GSIB faces a capital problem somewhere else on its balance sheet, in mortgages, loans, or corporate credit. Precious metals positions, though often profit-making, are not core to survival. In a crunch, the bank may choose to shrink risk wherever it can, including metals. Tightening credit lines to metals clients, forcing early settlement, reducing unallocated offerings, or making physical delivery harder or more expensive are rational moves if the goal is to conserve capital and funding. But on your side, they look like the walls closing in between you and the metal you thought you could always reach. Court cases like the spoofing scandals show that, at the micro level, rules can be bent for profit. GSIB regulations show that, at the macro level, profit and survival incentives push these institutions to treat your silver as a buffer and tool. Put them together, and the GSIB secret stops being a single revelation and becomes a framework, the structure. Of modern banking is such that your silver is safest for you when it is least useful to them, and most useful to them when it is most abstract and distant from you. The next question is obvious and unsettling. In a genuine stress event, whose interests prevail? To understand how fragile the bridge between paper and physical silver can be, imagine a stress scenario. It doesn't need to be apocalyptic. It could be a sharp inflation shock, a geopolitical event that disrupts supply chains, or a credit crisis that undermines confidence in banks or currencies. In such moments, investors historically flock to hard assets. Silver, with its dual role as a monetary and industrial metal, feels attractive. Cheaper than gold per ounce, but still a tangible store of value. Demand for safe haven exposure spikes. The tension lies in where that demand is directed and how GSIB structures respond under strain. If most of the new demand flows into paper channels, the system can at first absorb it. ETFs issue new shares, custodians source metal or hedge with futures, unallocated accounts swell as clients move cash into silver balances, futures open interest rises as speculators lever up. A GSIB metals desk sees surging flows, widened spreads to manage risk. increases hedging, and draws on credit lines and stable funding as required. On the surface, markets are functioning. Prices rise, but in a controlled fashion. Volumes are robust. Commentators declare that liquidity is ample. But beneath the surface, several constraints tighten. Physical inventories available for immediate delivery begin to shrink. Vault stocks on COMEX and in LBMA warehouses might still look large in absolute terms, but the portion not already spoken for via ETF holdings, industrial contracts, and pre-existing obligations may be small. Refining capacity, turning mine output and scrap into deliverable bars, is finite. Logistics, especially in times of broader crisis, can become messy. At the same time, NSFR and other funding rules mean GSIBs can only expand balance sheet intensive activities so far without raising new stable funding or cutting back elsewhere. Now imagine a subset of investors decides that paper exposure is not enough. Perhaps rumors circulate that some unallocated accounts are fractionally reserved, that some ETFs allegedly have complex leasing arrangements behind the scenes, or that a major GSIB is under stress. Social media amplifies every hint. A wave of clients requests physical delivery from unallocated accounts or tries to redeem large ETF blocks via authorized participants. Physically settled futures contracts see more holders stand for delivery rather than rolling over. What was once a quiet assumption that only a tiny minority would ever ask for bars begins to crack. GSIBs, as core intermediaries, now face a different problem. They have contractual obligations to deliver metal, but their operational ability to do so at scale is constrained. They can try to buy in the spot market, but that pushes prices higher and risks losses on hedging books. They can borrow metal from other institutions, but in stress, those institutions may be reluctant to lend. They can draw on strategic inventories, but those are finite and may already be encumbered. And remember, regulatory capital and funding rules still apply. They can't simply balloon their balance sheets with high-risk commodity exposures without endangering compliance. What tools remain? One is to change the terms of engagement. Banks can offer clients incentives to accept cash settlement instead of metal, perhaps at a premium to spot. Futures exchanges can, if strain is extreme, alter delivery rules, raise margin requirements so high that many participants are forced to close positions rather than stand for delivery or, in the worst case, declare cash settlement only for certain contracts. None of this is theoretical. In other commodities and in historical monetary systems, shifts from promised convertibility to cash settlement have occurred when stress became too great. For retail investors, such a development would feel like a betrayal. You believed, I own silver. But in a crunch, what you actually owned was a right to the cash value of silver as determined by a market dominated by institutions managing their own survival. The more your claim sat within the GSIB-centered structure, unallocated, ETF, derivatives-based, the more subject it would be to that transformation. Physical holders with bars in hand or in tightly controlled allocated storage would be inconvenienced by price volatility but not by convertibility risk. Those relying on the promise of easy conversion from paper to physical could discover that easy was always contingent. Add another twist. In a systemic crisis, governments and regulators prioritize stability. GSIBs are, by design, protected to prevent cascading failures. That doesn't mean shareholders or some creditors can't lose money, but the system will bend rules to avoid a collapse. If honoring every paper-silver claim with physical metal would trigger funding strains or risk broader market chaos, authorities are more likely to permit or encourage cash settlement, temporary rule changes, or other measures that break the link between claim and bar. Legally, many contracts already anticipate this with language that allows for alternative performance or force majeure. This is the climax of the "they want your silver" narrative. It's not that men in suits will physically confiscate your coins. It's that, in extremis, the System S priority is not to preserve the sanctity of your individual claim to a bar somewhere in a GSIB-controlled vault. It is to preserve the functioning of the system as a whole. Your silver, to the extent it exists as part of a web of bank promises and derivatives, is a cushion they can and will reshape if necessary. The asymmetry of power and information between you and the GSIB structure becomes brutally clear only under stress, precisely when you hoped silver would protect you. Importantly, none of this guarantees that such a crisis will occur, or that if it did, the outcome would be catastrophic for every paper holder. It is entirely possible that, in many scenarios, markets would clear, cash settlements would be honored at fair or even elevated prices, and only those insisting on physical in the worst moments would be disappointed. But the risk profile of paper silver versus direct physical is starkly different, and GSIB regulations and practices tilt the system toward cash settled, credit-based resolution rather than literal delivery of metal. That is the structural secret. Convertibility is a policy choice, not an absolute. Once you see that, the question shifts from, are they out to get my silver, to what exactly do I own and through whom? And that leads to the final part of the story. Not a call to panic, but a clear-eyed look at how an informed person can navigate a world where GSIBs sit between your savings and the metal you think you hold. By now, the phrase, "they want your silver," should sound less like a movie tagline and more like shorthand for a real tension. G SIBs and the regulatory framework around them have shaped a silver market where most participation happens through layers of claims, products, and intermediaries. Your desire for silver exposure feeds a system that uses your capital and trust to generate profits, manage balance sheets, and, in extremis, absorb shocks. The final step is to translate this understanding into practical, grounded insight, not hysteria. First, clarify what forms of silver exposure actually exist. At one extreme is physical silver you personally hold, coins and bars in your possession. You face storage, security, and liquidity issues, but counterparty risk is minimal. A step removed is fully allocated, segregated storage with a reputable non-bank vaulting provider where bar lists and serial numbers are in your name, audited, and withdrawal rights are clear. Further out are allocated or unallocated accounts with banks, including GSIBs, where legal documentation, not marketing language, determines whether you own metal outright or claim on the bank. Then come ETFs and similar funds, which own metal or derivatives through custodians, often large banks. Furthest out are leveraged or derivative-based instruments, futures, options, CFDs, that give you price exposure but no direct link to physical metal. The G SIB secret is that the last three layers, bank accounts, ETFs, derivatives, are where your silver becomes most useful to the system and least tangible to you. None is inherently bad. ETFs, for example, have brought down transaction costs and democratized access. Futures markets allow miners and industrial users to hedge real-world risks. Unallocated accounts make it easier for wholesalers to transact large volumes efficiently. But the more you rely on these structures, the more your fate is tied to the health, incentives, and discretion of GSIBs and the broader regulatory apparatus. An informed person then does two things. First, they read the fine print. Does your silver account at a bank explicitly state that you own specific allocated bars? Or does it reveal that you are an unsecured creditor of the bank with a right to metal or cash at the Bank S option? Does your ETF's prospectus describe physical holdings, leasing, and lending practices in detail? Who are the custodians and sub-custodians? What is their regulatory status? Are they GSIBs? These documents are public, but few investors take the time to parse them. The supposed secret is, in large part, hiding in plain sight. Second, they align exposure with purpose. If your aim is to trade silver's price over days or weeks, the counterparty and convertibility risk of futures or ETFs may be acceptable. Your time horizon is short. You're playing in the same arena as hedge funds and bank desks. If your aim is long-term wealth insurance against systemic risk, the calculus changes. You might prefer a higher proportion of exposure in forms less integrated into the banking system, physical in hand or tightly controlled allocated storage, because those are least likely to be reshaped in a crisis to protect GSIB balance sheets. What about the fear that GSIBs and regulators will eventually move directly against physical holders through windfall taxes, reporting requirements, or even confiscation? History shows this is not impossible. 20th century gold confiscations in certain countries are a sobering precedent, but such steps are politically explosive and legally complex. More often, systems evolve through subtler channels. Regulatory incentives that favor certain products over others, tax rules that advantage paper exposure, or market structures that gradually centralize custody in GSIB-controlled vaults. The most effective way they can get control over your silver is not to seize it, but to convince you to leave it with them in forms that serve their purposes. There is also a sobering counterpoint. The GSIB-centered system, for all its flaws, is capable of providing deep liquidity, tight spreads, and global access. A world with no large intermediaries would not necessarily be more stable or fair. It could be more fragmented, less transparent, and vulnerable to different kinds of abuse. The real choice is not between purity and corruption, but between understanding the trade-offs of each form of exposure and structuring your affairs accordingly. So where does that leave the secret they don't want you to know? Reduced to its essence, it is this. The modern silver market is, above all, a credit and derivative system layered on a limited physical base, run through institutions whose primary duty is to their own solvency and regulatory compliance, not to your ideal of sound money. Your participation, especially via paper instruments custodied or intermediated by GSIBs, helps maintain that system. When everything is calm, you benefit from its efficiency. In a storm, your claims can be reprioritized, redefined, or settled in ways that stabilize the system, even if that conflicts with your expectation of simple, I own silver. Understanding this is not cynicism, it is realism. The suspense at the heart of the story, what happens if everyone asks for metal at once, or may never be fully resolved. Systems often muddle through, crises are averted at the last minute, and life goes on. But the practical takeaway is clear. If silver is part of your financial life, know which version you own. System silver, which lives inside the G SIB Basel regulated web, or sovereign silver, which sits as close to you and as far from that web as you reasonably can manage. The more you blur the line, the more your wealth becomes a tool in someone else's game. The more you clarify it, the less their system quietly wants your silver, and the more it actually belongs to you.